So now we will start with the next part or continuation of what we have been discussing. Now we'll be discussing the various elements. Element means basically the components of balance sheet, income statement, and all of those items, right? Now, first we'll start with the elements of balance sheet. If you look at a balance sheet, this is the balance sheet. In a T-shaped format, whatever you have learned earlier, if you remember that, you have assets on one side, you have liabilities on other side, and then you have something called as equity, which we also call as capital, right? Now, what we have understood is equity is something which is left after paying off the liabilities. So you will use these assets, your property, plant and equipment, your inventory, your account receivable, bank balance. You will use these assets first to pay the liabilities, and whatever is left will be taken by equity. So now we have to understand what is the meaning of an asset, liability, and equity. These are the terms which you have learned as a part of your accounting since the time you have started learning, but we'll put a specific definition so that whenever you're accounting for a transaction, you will get to know whether this item is an asset or it is to be treated as an expense. So one very important thing that you have to understand is, as we move ahead in the professional accounting framework, what we need to understand is there can be an item of expense. I have carried out repair of a machinery, or I have done painting for a building. So if I have to ask you, if I have done painting for a building, let us say, the building is 5-7 years old, and now I have done, or I have, whitewashed the building. I have done a repainting of the entire building. Should that painting be called a capital expenditure or a revenue expenditure? Meaning to say, should I say it is my expense or should I say it is my asset? Painting of building. Can you type the answer? As per you, should painting of building be treated as repair or should painting of building be treated as an asset? Okay, expense. Right. Now, the default thing comes is expense. Now, let us go slightly deeper into the transaction or the event that has happened. When I am painting a building, what do you think would be the life of the painting? After how many years should I paint again on an average? 5 to 7 years. Now, if there is an item of painting which has a life of 5 to 7 years, how can I say it is an expense for 1 year? Right. So what we do is that painting cost, only the painting cost is shown as a capitalized item, as an asset, because it is protecting the building. It is giving a look to the building for 5 years or 4 years or 7 years, whatever is the case. Okay. So that gets actually capitalized, because when you construct a new building, you capitalize the painting cost. When you construct a new building, you will say the painting cost is a part of cost of the building. But the painting has a life of only 4 to 5 years. So after 4 to 5 years, when you repaint the building, again, you will capitalize those, the expense. So it will not be a revenue expense because it is an expense which can be used, or it is an item which can be used for 4 to 5 years, right? So these are the things that we need to understand when we understand the definition of assets, or when we come to fixed assets and all of those things. Okay, it is not only a thing like, okay, this is an expenditure, let me charge it off. We need to understand the underlying impact of that, right? So first we'll start with asset. Whenever we say it is an asset, it has to be a resource. Asset is always a resource. Resource means something which is favorable or something which will give us benefit. Sir, what kind of benefit will a painting give? Now, if you look at the painting part, it is not giving us direct benefit. It is giving us indirect benefit, because if the painting of a building is not proper, you may have water seepage issues. Customers may not like to visit your store. So it is not only direct benefit, it is also a kind of indirect benefit that we consider, right? So when we say an asset has to be a resource which is owned or controlled. Owned or controlled. So either I should own it. When I say I should own it, it is my property. Second one is control. I don't own it, but I control. For example, if I take it on lease for 5 years, 10 years, and I can control the use of the asset, that is also part of control. Or sometimes, let us say we have taken rights related to mining, or we have taken a land on which we can carry out mining activities from the government. land is not owned by us, but we can control the land for the period of the term for which we have received the right to use that particular land. So this aspect we'll understand in leases subsequently in more detail, right? So it is a resource which is either own means my own property, controlled means I have the right to use, I have the right to direct, I have the right to say who will use that particular property or who will use that particular resource, which will give us future economic benefits. So any item when you put it in the balance sheet as an asset, it has to be a resource, it has to be owned or controlled by the entity, it must give me future economic benefits. These are the three components which we must be careful about. Now, for some items like the air conditioning system in this particular studio where I'm taking the class from, okay, or the computer anyways I'm taking class for, let's say I have an accountant, that accountant is using a computer. Now that accountant is using a computer is not giving me any revenue, but I need that accountant to use the computer so that the business runs smoothly. So this future economic benefits can be direct, can be indirect. So it can be direct benefit, it can be indirect benefit, right? So if it meets this condition, we say it is an item of asset. That is why whenever you make a purchase, this is not an expense. It is an asset. When you purchase goods, it is inventory, which is an asset. When you sell the goods, that time it becomes an expense. So coming back to the definition, assets are resources controlled by the entity as a result of past events. They represent probable future economic benefits to the entity. Probable means more than 50% chance. Okay. So any item you see on the balance sheet, inventory, accounts receivable, investment, property, plant and equipment, all of these are called as assets. Simple definition. I hope there is no confusion in this. If you have any confusion, you can ask me, but I think this is a very simple and straightforward thing. Okay. Now, moving on to the next part. So we have understood assets, then liabilities. Again, we will be having a more elaborate discussion on each of these items. Liability. Now, when we say liability, you have to consider three aspects: present, past, future. Present, past, and future. Sir, what is there in the present? In present, there is an obligation. Obligation means there is some kind of responsibility, there is some kind of burden. For example, I have occupied this property for 1 month. Once I've occupied this property for 1 month, there is an obligation on me to pay rent. So it has to be a present obligation. Whenever we use the term liability, it has to be a present obligation. It cannot be a future obligation. I will occupy this building for 5 years, and for that 5 years, I have to pay rent in those respective months. That is not my obligation today. So it has to be a present obligation. So now, sometimes what happens is, I have entered into, let us say, this lease contract, rent agreement, non-cancelable for 1 year. Means what? For 1 year, I cannot cancel. For 1 year, I cannot cancel. So if I cannot cancel this lease agreement for 1 year, then 1 year portion becomes my liability because I have an obligation. If I vacate it today, I have to, pay the rent. So there is an obligation. Now, accounting part of this, we will understand in leases, especially aspects related to rent. Okay. So if there is a purchase of goods, once you have purchased the goods, there is a present obligation. If I want to purchase goods, that is a future obligation. But if I purchase the goods, it is present obligation. So a liability is a present obligation which has arisen because of past events. So events have happened in the past. Sir, what kind of event? Purchase of goods. Event in the past. Borrowed money and I use the money. Event which has passed. So past event, present obligation, and in future, there will be outflow of sources. So liabilities are present obligation arising out of past events, which will result in outflow of resources in future. That is why if some court case is going on, we say it is not a present obligation. It is not a present obligation. It is a, it may be a future possible obligation, but currently there is no obligation. So only if you have a present obligation, coming because of past event and it will result in outflow of resources in future, you define it as a liability. So, liability are present obligation arising from past events. Their settlement is expected to result in an outflow of economic benefits from the entity. So, there would be some outflow of resources which have few economic benefits. So, when you have to settle a liability, let us say creditor, what do? You have to pay money. If you have to pay interest, you have to pay money. If you have received advance from the customer, so advance from the customer, I have an obligation to provide goods in the future, services in the future. So that is also called a liability. Then equity, what we have discussed, is the residual interest in the assets of the entity after subtracting all its liabilities. So equity includes common stock. Please remember, we are doing US GAAP, so the terminologies will be slightly different. Common stock is your equity. Equity shares, what we call in India. Common stock is for US. Preferred stock, the preference shares. Retained earnings, all of us know. Okay, so please understand, equity, which is the residual interest, it increases because of profits, capital contribution. It decreases because of losses and distributions. Distribution means when you pay dividend, your equity balance goes down. Now, assets and liabilities are classified as current and non-current. We'll come to it, subsequently, and they are reported in order of liquidity. Liquidity means what? The one which can be, so this is again specific to US GAAP. Okay, it is not respect to Indies. In Indies, if you see, you will, or if you look at AS also, first you will report long-term assets or non-current assets, then current assets. But when you look at US GAAP, you're saying you will report in order of liquidity, means the one which can be converted quickly into cash, that will be presented first. So you have current assets first, in that you have cash, short-term investments, account receivables, inventories, prepaid expenses. In that reverse order you are presenting. Liabilities also accordingly, current liabilities first, non-current liabilities next, and equity last. Okay, this is called the liquidity order. You also can use the reverse liquidity order or the production order, which is presenting non-current assets first, then the current assets, then non-current liabilities first, then current liabilities, then equity. Okay, so this is the format in which you will present in the financial statements. Right now, we are only understanding the framework, that these are the various items. All of these items are separately covered in subsequent chapters. Okay, so note payable is something like this is a terminology which is most likely used, more used in US, and where they say note payable is something like when you take a loan, they write a note payable, like your bills payable, right? That I agree to pay so and so amount. So whenever you borrow a loan, you execute a note payable. So that is a kind of loan. So non-current is beyond 12 months, current is within 12 months. The most important discussion is to understand current and non-current, for which we need to understand the operating cycle. What is the operating cycle? Okay, there is one is operating cycle, one is cash cycle. We are talking about operating cycle. Operating cycle means, if you look at any industry, and this comes more from manufacturing setup, can be applied to service also. Operating cycle is the time, or let us say, if you look at a manufacturing setup process, what happens? You have purchase of raw material. After you purchase the raw material, you carry out production. Then after production, you have finished goods. Then finished goods are sold to debtors or account receivables. Then you receive cash from the debtors, right? So let us say you purchase the raw material on 1st of January of year 1, or I'll just say 1st of January. On 1st January itself, you will not give it for production. The raw material is brought to your warehouse or go down, you store it for some time. Let us say on 15th of January, On 15th of January, you give it to production. On 15th of January, you give it to production. Now, some industries have quick production times. Today itself, the production will happen. But look at industries which take long period of time. For example, a car manufacturing setup. These days, of course, due to advancements and all, you can manufacture a car maybe in 2 to 2 days or 3 days time, but still it'll take some time, right? Or if you look at businesses where a big machinery is being assembled. So production also takes time. So say, for example, production takes, 15 Jan, it is issued for production. And on 21st of Jan, production completed. Now, immediately the day when the production is completed, you will not be able to sell. So let us say finished goods is sold on 15th of February. Okay. And debtors will not pay you immediately. Debtors, 15th February, credit period, 1 month. So on 15th March, you receive the cash. So if you see this cycle, you purchase raw material, you gave it to production. From production, it became finished goods. From finished goods, it became debtors. From debtors, it became cash received. The time it takes from 1st of January till to complete this entire cycle and to reach 15th of March, this is called operating cycle. This is called operating cycle. Okay. Operating cycle is used to classify whether an asset or a liability is current or non-current. Okay. So this entire cycle is an operating cycle. This entire cycle is an operating cycle. Now, to classify something as current and non-current, you have to check 2 categories. One is 12 months. One is operating cycle, whichever is higher. So what we need to do is higher of 12 months and operating cycle. Now, in this case, from 1st of January till 15th of March, it is less than 12 months. So what we will take? We will take 12 months period. Okay, I'll just put current. Okay, 12 months or operating cycle, whichever is higher, that is what we consider. So if asset is or will be realized within 12 months or operating cycle, whichever is higher, then we say it is a current asset. Okay. Liability will be settled within 12 months or operating cycle, whichever is higher, then it is called a current liability. So we have to check by default anything which will be settled within 12 months. Now the question comes at 12 months from which date? Date of sale or year end. So you have to check date from end of reporting period. So from the date of balance sheet. From the date of balance sheet, if something will be paid within 12 months, it's a current liability. If some asset will be realized within 12 months, current liability. If liability will be realized within the operating cycle, means let us say the operating cycle is greater than 12 months. Now, what could be the industry where operating cycle is greater than 12 months? One industry is construction industry, where the operating cycle may be 3 years, 4 years. When you have to construct a flat, it is not that it will be completed in 1 year, right? If someone is constructing an apartment complex, it will easily take 3 to 4 years. So the operating cycle there will be 3 to 4 years easily. So something which will be realized within 12 months or the operating cycle, whichever is higher. So if operating cycle is 3 years, you will consider a 3-year period. If anything will be realized or settled within that period, you call it to be a current asset or current liability. Apart from that, anything else you have, you will classify them as non-current asset and non-current liability. Okay, so if operating cycle is 15 months, then you will say within 15 months, whatever you pay from the end of reporting period is current. Okay. If operating cycle is 8 months, whatever is paid within 12 months, you will consider it to be correct. So minimum 12 months, anyway, you will consider it to be current. If operating cycle is longer than 12 months, you will consider the operating cycle. Okay, that is how you classify current and non-current liability. An asset is classified as current on the statement of financial position, that is our balance sheet, if it is expected to be realized in cash or sold or consumed. So either you will realize the asset or you will sell the asset like inventory, or you will consume again inventory within the entity's operating cycle or 1 year, whichever is longer. So majorly cash is a current asset. Trading available for sale and held to maturity debt securities. If so, held for trading is anyways current, because if I'm saying I am holding investments for trading, means I will sell them in a short period of time. So when we say securities, these are investment. Debt securities are like your bonds. If I'm holding a bond for trading means buying and selling, I will sell it in a short period of time. Hence, it will be a current asset. Similarly, available for sale. If a security is available for sale, means I am selling them within 12 months and it is a current asset. Receivable, always a current asset, because that is a part of your operating cycle itself. Inventory is current asset. Prepaid, generally within 12 months period, so current asset. And certain individual investments in equity securities, if the intention is to sell it within the next financial year, it will be current asset. Non-current asset, whatever is not a current asset is non-current asset. Then what are the items or categories of non-current asset? The major one is property, plant and equipment. Property, plant and equipment. Property means your land and building. Plant and equipment means your plant, machinery, equipment, air conditioning system, whatever you classify as property, plant and equipment, that is considered to be a non-current asset. Then intangible assets like patents, goodwill, trademark, because generally by definition, when we come to definition, you will see these assets will be held for more than 12 months period. Okay, they'll be held for larger than the operating cycle. So these are classified as non-current assets. Then investments and funds which are intended to be held beyond the longer of 1 year or operating cycle. So something which we intend to hold beyond 1 year, like investment in equity securities of another entity. Don't worry about control and all of that. Those aspects we'll discuss subsequently. So simply understand, if you have invested in equity securities, it is a non-current. Then available for sale and held to maturity debt securities may be non-current depending on the criteria. Okay. Then coming to current and non-current liabilities. Current liabilities, examples, account or trade payable, standard. These are always current liabilities. Other payables like wages, salaries, rentals. So if you have to pay wage, rent, you pay it on a month-to-month basis. Taxes. Unearned revenue. Unearned revenue means you have collected money in advance, but you have not yet provided services. Classic example, this class that I'm conducting. We have collected the entire amount from you. We have given you books. We have given you access to resources. We have given you online access to GLEM material. We have given you access to question bank, but we have not yet conducted the classes, or we have not yet provided you the classes. You are still watching these classes. So these are unearned revenue. Whatever amount we collected from you, we will say that is a part of unearned revenue. Money received in advance for which goods or services will be provided in the future. Then other obligations like short-term notes. So these short-term notes are nothing but payable, bills payable. Then payment on current portion of serial bonds or other non-current debt. Now, what it means is, say for example, company has issued bonds 1,000. Okay. Every year 200 is repaid. I'm not talking about interest. I'm talking about the principal. So this 1,000 is a 5 years bond. So this 1,000 is a non-current liability. But out of this 1,000, 200 will be paid in next year. Out of this 1,000, 200 will be paid next year. So 200 is current. 800 is non-current. So a single liability also will be split into two parts. How much is current? How much is non-current? Current is the one which will be paid within 1 year period. Non-current is something which will be paid beyond the 1 year period. Okay. So 200 and 800, that is the classification. Then long-term obligations that will become callable by the creditor because of the debtor's violation of provision of debt agreement at the balance sheet date. Now, this is another case where there is a long-term loan repayable after 10 years, but there is some default in, let us say, filing of quarterly statements of assets. So generally what happens is when you take a loan, you have to give some information to the bank. The bank says periodically give me statement of inventory, statement of debtors, statement of revenue, provisional balance sheet. Every quarter you have to submit. If you don't submit this 10-year loan, I will call it immediately. So if I don't submit the statement, we say that it is a technical default, and the bank can say, please pay my money in advance, or please pay all the money because you have not submitted or you have defaulted. Or sometimes what happens is the bank says maintain a debt to equity ratio of 2:1. We fail to maintain that debt to equity ratio. If we did not maintain the debt to equity ratio, the bank says, please pay back my money. Okay. So if there is any violation, or let us say there is fraud or whatever reason it is, because of some violation of the terms of the loan becomes payable immediately. And if the loan becomes payable immediately, then though it is a long-term loan, initially we said it's a 10-year loan, and now we have defaulted. Can the bank demand the money? Yes. So then it becomes a current liability. Possible obligations for warranties. So this will again understand warranty provision and all of that. These are current liabilities. Okay. Then, if there is a short-term debt, company intends to refinance on long-term basis. That means, let us say I have a 3-month loan. Okay, this 3-month loan is due, let us say, in December of a particular year. This 3-month loan is due on December of a particular year. Now, what I've done is, I don't have money to pay this 3 months loan. So what I did, so let's say this 3-month loan is from SBI. I approached SDFC and I said, boss, this 3-month loan of 100,000, I don't have money to pay to SBI. This is due in December. So can you please refinance this loan? Refinance means take over this loan. Take over this loan. So what HDFC will do? HDFC will pay the amount to SBI. Okay, HDFC will pay the amount to SBI, and now it becomes a new loan by HDFC to the company. And this loan is, let us say, now HDFC has agreed for 5-year term. Now, strictly speaking, a loan which is due in 3 months' time is a short-term loan and a current asset. Correct? Now, if I have got it refinanced, I have got a new loan, balance transfer for a 5-year term, then now it will not be a current liability, but it will be a non-current liability. I'm repeating once again. If I have taken a short-term loan, but I will refinance it, or I have refinanced it, or a bank has agreed to refinance it, then when it is evident that it will be refinanced, you will not show it as a current liability. You will show it as a non-current liability. If you look out in the market also, you will see a lot of times credit card balance transfer, home loan balance transfer, personal loan balance transfer. So if you're transferring a short-term loan and converting that into a long-term loan, then the substance, the actual substance of the loan is a non-current loan, and hence you will classify it as a non-current liability. Then anything which is not current becomes non-current, like non-current notes and bonds. Notes payable is like loan, bonds is like debenture. Lessee's liability, will come to lessee's accounting briefly. Deferred tax liabilities, always remember, deferred tax assets and deferred tax liabilities will always be classified as non-current only. Some obligations under product service warranty agreements, if it is extending beyond the 1 year. Deferred revenue, again, if it is extending beyond 1 year. Advances for non-current commitments. So all of these are your non-current liabilities. Now, in the entire discussion of current and non-current, two things you have to keep in mind. One, 12-month or operating cycle, whichever is greater. And specifically for liabilities, the two key portions that you have to understand is where likelihood of you being tested in the examination is payment on current portion of non-current asset. So, non-current debt. So, the liability is non-current. If you look at the term, it is a 5-year loan, but portion of the loan is being paid within 12 months. That part you will classify it as current. So, if whatever is being paid within 12 months period, that will be current. And second, short-term debt, if it is being refinanced on a long-term basis, that will not be current, that you will classify as non-current. Okay. So, this is the gist of the discussion we had. Any question? Okay. Now, we have discussed assets, we have discussed liabilities, and these, see, we have been discussing all of these since we started learning accounting. Just that because it is US GAAP perspective, there will be some nitty-gritties here and there, the way they use the term and all of that. That's the only, challenge. Okay. And as we see the MCQ questions, when we start practicing MCQ questions, that is when you will realize that, okay, there will be something which is slightly tricky when it comes to evaluation, right? Then coming to equity, as I told you earlier, it represents the ownership interest. Who has contributed money? Ownership interest, that is equity. Okay. Now here equity does not mean equity share capital. Here equity means ownership interest. Here equity means ownership interest. Now, what are the sources of equity? Capital contribution by owners. Capital is your basically equity share capital or preference share capital. But here the term we will use is common stock and preferred stock. So whatever is the face value or par value of common and preferred stock, that is the capital contribution. And this term, please note it carefully, additional paid in capital. Now, additional paid in capital is nothing but something like your securities premium account. In US GAAP, there are other sources of APIC also. We will not be required to go into too much of details. But if there is a gain on cancellation also, let us say you have purchased, bought back your shares and you have made a gain there also you will have additional paid in capital. Okay, like we have capital reserve here, there you put it under additional paid in capital. So additional paid in capital is nothing but like your securities premium account. Then retained earnings, profits which is earned by the company, that belongs to owners. So this profit year on year basis gets accumulated and you will show them as retained earnings. Any dividends which are paid out of the retained earnings. Then treasury stock. Sir, what is this treasury stock? The company, when it purchases its own shares and holds it as investment or holds it as investment, that is called treasury stock. Okay. So shares bought back but not yet cancelled are shown as treasury stock. This is shown as a negative item in the equity section. So what happens is, let us say you have equity, you have common stock, you have preferred stock, you have APIC, then you have treasury stock. This treasury stock will be a negative number. Why? Because we have bought back. Okay. You will not show it as an investment. You will show it as a negative stock. Then accumulated other comprehensive income. I have been discussing about this, that some items which are not shown in P&L are shown in other comprehensive income. It will be presented separately in the balance sheet. Okay. So if you see the breakup, I hope you are able to see the breakup of various items in the equity section. Okay. So if you see the breakup, you have capital stock, which is stated at par value. So here you have preferred stock, that has had preference shares. Then common stock, which is like your equity shares. But now I will no longer be using equity shares and preference shares. I will say common stock and preferred stock. Okay. This is at par value 50,000 and 300,000. Then additional paid in capital. So excess of issue price over par value, that is a securities premium. Then sometimes they make profit on treasury shares, that is also shown here. If there are some defaulted stock subscription, means some persons have applied for shares but they have not paid the amount, so that is shown here. All of these are shown under APIC. Retained earnings, basically accumulation of all your earnings which will be distributed subsequently. Then other comprehensive income is shown here, and see this cost of shares in treasury. So you will reduce the cost of shares in treasury and that will give you the total shareholders equity, which is so much. And you're not required to prepare consolidation right now. So when we come to that, you will also have something called as non-controlling interest or the minority interest, and that will give you the total equity, right? So that is all about the assets, liabilities, and equity, right? Now, few limitations, we can just discuss this briefly. One is it is historical. The information given is historical and it is given at a point in time. So you only know the information at a given point in time and things change pretty fast, right? Second thing, a lot of judgment goes into preparation of these financial statements, right? You have to make certain estimates, you have to determine the fair value, you have to determine the useful life. So there again, there is a lot of management judgment. Window dressing might be possible. So first is it shows company's financial position at a point in time, and there may be a lot of variations, and you can, and a lot of time what happens is nearby the year end, they try to manage the accounts. So that also becomes a challenge. Then it gives us historical information at historical cost, which may not be equal to fair value. I might have purchased land 10 years back. The value today is much, much higher. And if I'm giving it at historical cost, again, that becomes a limitation because it does not give us a true picture. The preparation of balance sheet requires estimates and judgments, and some items cannot be recorded objectively but have financial value to the company. Now, this to give you a best example, a company in the IT sector, or let's take the example of TCS. Now, for TCS, the maximum or the most important resource is, what do you think? What do you think is the most valuable resource for a company like TCS or Infosys? Human resource, employees, 5 lakh employees, and that is where the organization stands, and that cannot be shown in the balance sheet, right? So when that cannot be shown in the balance sheet may not reflect true pictures, especially where human resource inbuilt, your brand name. Now TCS cannot say or present its brand name as an asset in the balance sheet. TCS cannot record its goodwill in the balance sheet. So it does not give us a true picture. Now, just to ask you, why can't we show human resource as an asset in the balance sheet? Why can't we show, or why cannot we show human resource in the balance sheet? Yes, quantification may be difficult, but I can still say present value of salaries that I will pay in the future. That can be one estimate, but yes, quantification is difficult. Employee turnover, employee. So very important thing is, if you go back to the definition, resource controlled by the entity. Now, you cannot control the employees. As what Shiva mentioned, you cannot control the employees. Employees may leave the organization. Apart from your notice period, you cannot control, right? So that point of time, you cannot recognize employees as an asset in the balance sheet. You may spend thousands of crores on their training, but the next day they may resign and go, and you will not be able to do it. Okay, so you cannot show them as asset. But if you compare this with, let us say, an IPL franchisee. Now, in an IPL franchisee, when there is a contract between the IPL, the team owner, and the player cannot play for any other team. In fact, if they have to play for any other country also, let us say there is a player from England who is playing IPL, who has signed the contract, they need a waiver, or they need no objection from the team owner. Only then they can play for the country. So that there you can see control, and that is also for the contract period in the IPL window only. Apart from that, there is no control. So here also, your 1 month notice period, 2 month notice period may be there, but apart from that, you will not have control, and hence you will not be able to show them in the balance sheet, right? So this covers broadly the assets, the liabilities, and the equity, the income statement and the statement of comprehensive income. Okay. Now, income statement is nothing but your P&L, but now we'll start referring gradually. We have to make the shift and we should forget, only for the exam purpose, we should forget accounting standards, Schedule 3 and all of that. And we should move to the terminologies which are used in the US GAAP. Okay. So income statement is basically, if you see, you will have revenue from sale of goods and services. You have other incomes and gains. You have expenses and you have losses. That's it. There can be an expense, interest expense, depreciation expense, salary expense, admin expense, whatever it is there. Expenses, losses, loss on sale of fixed asset or loss of inventory, gains, gain on sale of assets, and revenue. All of these put together are elements of income statement, and income statement is presented for a period of time, generally 1 year, and also as per the regulatory requirements, quarterly the statements can be prepared, right? Now, very important to distinguish between revenue and gains. What should we call as revenue? What should we call as gains? Please look at the definition very, very carefully. See, if you ask someone, intuitively, they will say revenue means what? From sale of goods, from sale of services. But then, can I say from sale of assets? If I have sold a car, fixed asset, can that be revenue? So that is what we need to be careful about. What item we present as revenue? So revenues are inflows, means cash inflow, or other enhancement of assets. Other enhancement of asset means what? I have not received cash. Account receivable balance increased. So when account receivable balance increase, it is also revenue. Inflows, enhancement of asset, or settlement of liabilities. Sir, what is the settlement of liabilities? As I gave you an example, you paid us money in advance. When you paid us money in advance, then when you paid money in advance, then what does that mean? It is a liability for us. Now, if it is a liability for us, when we provide you services, that liability is getting settled. So that liability is getting transferred to revenue. So whenever we say revenue, this is a credit item. Now, when revenue is a credit item, what will you debit? You will debit either cash or account receivable or liability. So if you have paid money in advance and I have shown it as a liability, I'll debit the liability and I will credit the revenue. Okay, so this is the first part. Now, where should this inflow and all come from? It should come from either delivering or producing goods. So if I am a trader or if I am into manufacturing, I have to deliver goods by providing services or other activities. So goods, services, generally goods and services, it covers all of those items, and sometimes interest also. That qualifies as ongoing major or central operations. So this is the key to the definition. Whatever money we receive from our core operations, from our main operations, that is called revenue. If I'm selling scrap, see, we publish books. Those books come in cartons. I'm selling those cartons. Sale of that carton is not my central operation. It is not my primary activity. So that cannot be called revenue. But if I'm selling books, it will form part of my revenue, right? Then that is revenue. So whenever you are looking at revenue, sale of goods, sale of services, provision of services from principal operating activities or central operating activities. That is why gain on sale of fixed asset, you don't say it is revenue. That is why interest on fixed deposit for a company like us, we will not say it is revenue. We will say it is other income, but we will not show it as a revenue. So revenue has to be from central operations, and generally on the other side, there will be a customer. Okay. Then what are gains? Gains are increases in equity or net asset other than from revenue or investment by owners. So here we are saying, sir, increases. There can be increase in asset. There can be increase in asset. What are the ways? One is revenue. Okay. Sir, when we have revenue, there is a decrease in asset also. Yes, there is a decrease. That cost of goods sold is happening. But parallelly, there is an increase in asset also. Increase in asset can happen because of revenue, can happen because of gains, can happen because of contribution by owners. Okay. So revenue comes from customers. Gains, sale of fixed asset. Contribution by owners. The owners have given us money. They have invested money. That also has increased our asset. So, if the equity, so when I say increase in asset, it also means that if the asset increases, it also means that equity increases, right? If net asset increases, equity will also increase. In the formula that I've written, if asset minus liabilities, if that increases, correspondingly, the equity also must increase because that is a part of the gain. So, gains are nothing but there is an increase in equity or net asset, but that is not from revenue, that is not from investment by owners. So, like gain on sale of fixed asset, right? So, that is what is considered as gain. Then, just opposite of revenue, we have expenses which are outflow or other usage of assets or incurrence of liabilities from delivering or producing goods, providing services or other activities that are ongoing or a part of central operation. So, what are expenses? Like revenue, when you sell goods, you have revenue. The goods that you are delivering, the inventory that you are delivering is an expense. There you can see there is an outflow of an asset or use of an asset like depreciation, or we have incurred certain liabilities, salaries to be paid. All of that are classified as expense. Now, if an expense or if an item of outflow meets the asset recognition criteria, you purchase a plant and machinery, that you will not say as an asset, that you will not say it as an expense. That meets an asset recognition criteria, you will call it as an asset. Okay. And then opposite of gains are losses. Okay. Where the equity or net asset decreases. Then all these transactions, revenue, gains, expense, losses, which impact the net assets of the entity are shown in the income statement, except what are not shown in income statement? Transaction with owners. Transaction with owners is not shown in income statement. So, sir, where do we show it? We will show it as a part of equity. So, whenever there is a transaction with owner means owner gave us money, show it under stock. We gave money to owners, reduce it from retained earnings. Don't show it in the income statement. Then, prior period adjustment. Now, this is one significant shift from you, especially if you have not read Ind AS. Prior period adjustment is also not shown in income statement. This applies to US GAAP, IFRS and Ind AS. In accounting standard, you would have learned separate disclosure of prior period item in the income statement or P&L. Here, prior period items are not shown in the P&L. Prior period adjustments are shown or are retrospectively adjusted in the opening retained earnings. So that we'll understand subsequently. But one thing is, you will not show it in the P&L. Then items reported in other comprehensive income. There are some specific items which are shown in other comprehensive income that again, you will not show it in the P&L. And transfers to and from appropriated retained earnings. So here if you see, there are some retained earnings which are appropriated. Appropriated means kept aside. I have kept aside for general contingency. I have kept aside something for future inventory decline, for plant expansion. So from unappropriated to appropriated, the movement what happens should happen in the balance sheet. It will not happen in the income statement. Some of these things you may not be able to understand fully now, but as we complete this particular study unit, you will be able to understand it fully. Okay. So that covers the income statement. Any questions so far? If long-term debt is defaulted, okay, and converted to short-term, but then the company declares bankruptcy, what accounting? See, once the bankruptcy is declared, then there is a specific way in which accounts are prepared as per the respective regulations. For example, if you look at India, you will prepare liquidator's statement, right? So someone called as liquidator or the insolvency professional, they will take over the company, the management and accounting of the company, and you will no longer prepare accounts on a going concern basis, right? So finally, it will be like, what are the receipts or amount that will be collected and what are the amount to be settled. So that preparation is very different from your going concern accounting. I hope I have clarified your doubt, Kishore. Okay. Now, We'll move slightly into specific aspects of, income statement. So we have revenue, cost of goods sold, cost of goods manufactured. You would have learned it as a part of, plan costing. You will also learn it as a part of costing, but we need to understand these terms so that we understand how these items are reported, right? So, as I told you, when you purchase, you debit inventory, you credit accounts payable. You debit inventory, you credit accounts payable when you purchase a product. Okay, this inventory is an asset. Now, when you sell this inventory, you have to create something called as cost of goods sold. Now, sir, what is this cost of goods sold? This basically says that what is the value of the goods which are sold. For example, just to give you an example, I have this phone. Okay, I have this phone. Not visible. Yeah, this phone. Now, if I buy this phone for selling, let us say I am a mobile phone dealer and I purchase this phone for selling purpose. So, if I purchase this phone for selling purpose, it becomes my inventory. I may sell it for some amount. Let us say revenue is 100,000. I also need to determine what is the cost of this mobile that I'm selling. That is what is called cost of goods sold. So this may be 80,000. So revenue minus cost of goods sold, what I get is I call gross profit, which is 1 lakh minus 80,000. This is one item. But I may be dealing with hundreds of mobile phones. And to count each and every mobile phone and see what is the cost of this mobile phone, what is the cost of that mobile phone, sometimes it may become difficult. So what we do is we take an approximation of cost of goods sold, which is calculated as opening stock or beginning inventory plus purchases plus other direct expenses like your transport, insurance and all of that, loading, unloading, minus closing stock. So what are we saying? We have so much of opening stock, some amount, okay? And then we purchased some specific items of goods, we incurred some more expenses, and there is some item lying as closing stock. Whatever is the resultant of this is called cost of goods sold. So if I have to just show you visually, let us say this is my inventory bucket, okay? And in this inventory bucket, this is my opening stock. This is my opening stock, okay? Then there were some purchases in the current period. Let us say this is my current year purchases. So my inventory bucket is being filled up. Then out of whatever I have purchased, I have not yet sold this much. So this much is not yet sold and it is lying with me. So if you see this was my opening stock, this was my purchases, and out of this much is not sold. So the portion which is sold here, this part is the cost of goods sold. How much of goods have I sold? That is given by cost of goods sold. Now this works well with units also, and it works well with amount also. So you have to remember, I call it the golden formula. COGS is OS plus purchases minus closing stock. Purchases, when I say, include direct expenses also. This formula you must keep in mind, because in costing also it will be really important when you learn cost management, when you have to determine what is the purchases, how much was the closing stock and all of that. Now, with this formula, we get cost of goods sold, and that cost of goods sold is the amount that will be shown as an expense in the income statement. Okay, so here you have beginning inventory 10,000, purchases 14,000 plus freight expenses 1,000 minus ending inventory 5,000. COGS is 20,000. Okay, any question in this? This is a basic calculation again. When you do a T-shaped accounting, you have something like 2 opening stock, 2 purchases by closing stock by sales, right? So the net amount of this opening stock plus purchases minus closing stock, that forms part of your COGS. Now, this is slightly more elaboration for manufacturing entity. You will again, as I told you, you will learn it subsequently as well. When I said I have this mobile phone and I have to sell this mobile phone, I am talking from a point of view of trader. I am not manufacturing. But when you have a manufacturer, the manufacturer manufactures product. And when they manufacture product, they need raw materials. They have to incur certain direct expenses like labor. Okay. Then to manufacture these products, so you have material, you have labor, you may have to incur certain indirect expenses like electricity, factory supervisor, etc. There could be depreciation on plant and machinery. So what happens is, when there is depreciation on plant and machinery, that also forms part of your cost of goods that you are manufacturing. For a trader, he is directly purchasing a finished product. But for a manufacturer, he will purchase raw material, he will incur these expenses, and he will produce finished products. So what happens is, raw material plus labor plus any other direct expenses plus indirect expenses. These are also called as overhead. So now you may have a doubt, sir, what is direct expense? What is indirect expense? Something which can be directly traced to the final product is a direct expense. Raw material is a direct expense. Labor is a direct expense. But something which cannot be traced to the final product, for example, factory supervisor. Now you cannot say how much of factory supervisor has worked on a particular product, because he's supervising the entire factory, right? So those are indirect expenses. Electricity, general electricity, indirect expenses. Machinery depreciation, again, very difficult to allocate. So you can do an estimate. Okay, I'm not saying no. You can make an estimate and say per unit we have incurred so much. But the amount of effort you will require to precisely estimate the amount is very high. So that is why what we say, these are overhead. So you have direct material, direct labor, and overhead. So largely put, direct material plus direct labor plus overhead. Okay. So all these expenses put together, what you get when you total all of this, you get cost of goods manufactured. Cost of goods manufactured means the total cost incurred by an entity to manufacture a final product. So you have material, labor, other direct expenses, and overhead. Sometimes what happens is, there may be work in process. Previous period work in process is worked into current period, and current period work in process is not yet complete, because everything may not be complete at the same time. Correct? So that is why you have beginning WIP, and you will deduct closing WIP. So cost of goods manufactured, you will add beginning WIP and you will deduct closing WIP, right? So this will give you cost of finished goods or cost of goods manufactured. Okay, if you have to add this. So direct material used in production, direct labor cost, and manufacturing cost gives me total manufactured cost. So here, because I have WIP, so I'll call it total manufactured cost. To that, if I add beginning work in process inventory and end in process work in inventory, I get COGM or cost of finished goods, or also called as COGM or cost of goods manufactured, right? Then this cost of goods manufactured, if I plot it here, this cost of goods manufactured or cost of finished goods, I'll plot it here. Instead of purchases, I will use cost of goods manufactured plus opening stock of finished goods less closing stock of finished goods. I get cost of goods sold. Okay. So if it's a manufacturing entity, if it's a trading entity, it is simple. Opening stock plus purchases minus closing stock gives me cost of goods sold. If it is a manufacturing entity, you'll find out the manufactured cost add beginning and less closing work in progress, you get cost of goods manufactured, and that you will put in place of purchases, you will get cost of goods sold, right? This, as I told you, will understand in detail in the cost management chapter. Now, raw material also, there may be opening raw material inventory, closing raw material inventory. So here also you will use opening stock plus purchases minus closing stock. That gives me raw material consumed. How much of raw material has been consumed? I have 100. I bought 1000 and 200 is left. So say for example, beginning raw material is 100, purchased is 1000, ending is 200. Means what? I have 100, I got 1000, total is 1100, 200 is left over. So consumed is only 900. So this 900 of consumption is what is captured here. So raw material consumed plus labor plus any other direct expense plus indirect expense gives me total manufactured cost, plus beginning inventory less closing inventory gives me cost of goods manufactured. And here I will have opening stock of finished goods, cost of goods manufactured, and closing stock of finished goods, which gives me cost of goods sold. So basically I'm saying, for example, I have 100, I have manufactured 1000, closing is 200, 900 is cost of goods sold. Okay, this formula, please revise it sufficiently, because sometimes calculation based on these are tested in the examination. Any doubt? Then, as I told you, gross profit is the difference between sales revenue and cost of goods sold. We have already covered it here, and somewhere I had mentioned so that is again revenue minus COGS will give me GP, and GP percentage is given by GP divided by. So quickly, let's take this example. Simple examples, but it will help us enhance our concepts and will help us in MCQs, especially in cost management. Okay. So we have inventory of raw materials. January 1st is beginning, December 31st is ending. Work in process 100,000, 120. Now, when dollar is given here, this dollar is for all the items. Okay. And finished goods, other information, purchases, direct labor, rent, utilities, advertising, and admin salaries. Right. Now, we are required to calculate the cost of goods sold and cost of goods manufactured. So first, this was not example 1. First, raw material consumed. Raw material consumed is opening RM plus purchases minus closing RM, or beginning raw material and all of that. Right. Raw material 65,000. How much did we purchase? 240. What is the closing raw material? 58,000. RM consumed is beginning plus purchases minus closing, which is 247,000. Right? Then 247,000. Then total manufacturing cost. Now, for total manufacturing cost, we need raw material consumed. From here, we can get it. Then labor. Labor, they have given direct labor. Please remember only direct labor, right? Direct labor, 300,000. Indirect labor will be a part of your overhead. Factory rent is an overhead. So you'll add factory rent as well, 80,000. Then factory utilities, electricity, water, etc. These are all overhead, 25,000. Advertising expense is not a manufacturing expense. These are expenses incurred after manufacturing the product, and administrative salaries are also not manufacturing expense, right? Then we have WIP, so total cost of production means the cost that is incurred in the production, which is 652. To this, you will add beginning WIP, what was there in the previous period as work in process, because that you would have completed in the current period. That is 100,000 less closing WIP, which will be completed in the next period. 120%. So 652 plus 100 minus 120. This gives me cost of goods manufactured. Now, after I got cost of goods manufactured, cost of goods sold will be beginning inventory of finished goods, that is 30,000. Add cost of goods manufactured, which is 632 less ending inventory. How much is the ending inventory? Ending inventory is 26. So 30,000 plus 632 minus 26, 636 is the cost of goods sold. 652, 636 is the cost of goods sold. Okay, so with this we covered broadly the items related to assets, liabilities, equity, income, and started with expenses and cost of goods sold.